Time now as well for today's morning brief. We have been keeping close tabs on everything discretion, the mentions about the consumer and how the consumer is even changing some of their own spending. Take a listen to some of the executives and what they have had to say to us here on Yahoo Finance about the very term.
So far right now, the customers is really hanging in there, but we're obviously watching what everybody else is too.
We sold more large hamburgers than we have in the last 6+ years at a time when, we have a trade up from 4 for $4 into a $5 biggie bag into a $6 biggie bag. So we feel like we got a good menu construct to bring folks in for one more visit, drive one more dollar that works for the consumer.
We have pricing power, but we're really thoughtful about it. We want to always remain a sweet, indulgent treat that's affordable.
We haven't seen much pushback. In fact, our loyal customers at the top end of our traffic, they've stayed with us. Those numbers have really been pretty even across the board. If anything, we've seen some pullback in maybe some of the less frequent shopper as we've kind of evaluated what's happened so far in 23.
However, there now seems to be a change in the tide as two recent events point to consumers being more selective on spending. Home Depot's unusually grim outlook, in part due to softer demand that pushes forward the discretion narrative for consumers. Meanwhile, U.S. retail sales for the month of April, they came in lighter than estimates. As far as the better than expected rise in ex-autos and gas, EY Parthenon chief economist Greg Dacko told Yahoo Finance that the non-inflation adjusted number is a key distinction there. And with Target joining in on a downbeat outlook, investors will be keen on Walmart's results for more clues on the consumption of discretionary goods here. And so for much more on this conversation, let's bring in our guests here this morning. Julie, you wrote this morning brief as well. Wanted to give you a shout out there.
Thank you. And obviously Target also following in this narrative this morning. So let's bring in Chris Versace, Tematica Research Chief Investment Officer, and Meera Pandit, JP Morgan Asset Management Global Market Strategist. Thanks to you both for being here. Really appreciate it. It does seem like something has started to shift, right? And one of the other differences, I think, in some of these early retailers versus those companies that we just heard from is that their quarter ends at the end of April. Mm-hmm. So, Chris, how concerned should we be?
Well, if we always try to follow the data, right? And there's a lot of data to be had. There's the monthly retail sales reports that you guys just alluded to. There's spending pulse data from MasterCard. Visa has a similar index as well. And when you kind of trace it back, some of this isn't exactly fresh news. Okay, so we've been a little concerned about certain areas, clothing, for example, furnishings, electronics. And as we saw in the April retail sales report yesterday, those areas were not only down for the month of April, but they were down for the 3 months leading into companies that report that quarter. So when we size that up against what we saw, Home Depot, for example, but really today with Target, not necessarily a huge surprise. But at the same time, Target said something that was interesting, right? Which is that the frequency business is doing well. So if you think about what that is, they called out beauty, they called out grocery. All of a sudden, you start thinking about Walmart, largest grocer in the U.S., right? You start to think about Costco and what's done leading into fresh food. Those types of reports, those companies could perform perhaps a little better than expected, whereas others that are more clothing heavy, electronic heavy, Gap, for example, who reports next week, could be a little more ominous.
It makes sense.
Right, and we've talked about as well, Meera, the fact that there has been perhaps this replenishment rate, not just among end consumers, but also among some of the retailers who are now impacting the kind of broader base of companies that are manufacturing some of the more durable goods or even the discretionary goods in the form of electronics as well. How long can that cycle continue to have perhaps a broader economic impact as well here?
Well, what we saw was we had a lack of inventories in the heat of the pandemic. What we ended up seeing is that all of a sudden people overbuilt inventories. So then we had this cycle throughout the course of last year of excess inventories, things going on sale. People no longer want all the goods that they wanted during the pandemic. So we're seeing an evening out of that dynamic. I would still say that the consumer is shifting from goods to services, and we're seeing that in a broad array of data. So I think it's going to continue to play out a little bit more. But I think that the brunt of excess inventories is probably behind us. When we think about the broader shape of the consumer, we're seeing that excess savings continue to dwindle. We're seeing savings rates that are lower than pre-pandemic. We're seeing credit card spending that's higher than pre-pandemic. But what's important is this is a slowdown from the pandemic itself, and yet the consumer is not weak. It is softening, but it is not weak. And that is, I think, where we've kind of hit up against some intellectual challenges in terms of thinking about the comparison to the last 2 or 3 years versus really kind of getting back to that pre-pandemic trend of normal.
Well, and as I wrote about in the morning brief today, it's not that they're weak, they're choosier. They're using more discretion when they're making purchases, right? I do have to wonder when this is going to start to be felt in services, right? And this is something we mentioned. EY Parthenon economist Greg Dacko a moment ago. He brought up the idea, well, we really got to watch that summer travel season carefully because tickets are expensive. Are people going to start to get choosier there? What kind of signs are you looking for on the services side?
Continuing, as you say, to look at travel, to look at restaurants, not only the demand, but also even on the hiring side. Because if you start to see some of those job openings dry up and you start to see less hiring, less for hire signs, then what that means is that demand is coming down pretty organically as well. So we look at both the labor side of it, the demand side of it, again, a wide array of data on the consumer itself and consumer surveys, consumer sentiment to see how consumers are actually feeling about inflation and what they're willing to spend on going forward. But I do think, again, given the starting line over the last couple of years, it will be still a gradual weakening in the consumer and it will take some time. So when we think about broader economic growth, where our pain point is perhaps not in the consumer, which is 70% of the economy, but more around businesses, business confidence, their access to loans and borrowing as we're seeing more credit tightening. So if we think about a slowdown in economic growth and a potential recession later in the year, what we're seeing potentially is that being driven more on the business side than the consumer side. And luckily, the business side is smaller relative to the consumer, which means we could potentially see a more mild downturn.
And so, Chris, with what you were mentioning earlier, the strength in frequency businesses offset by, of course, the softness in discretionary categories, which we've been talking about, who is best positioned right now to benefit from the frequency business that Target is calling out?
Sure. Well, I would say probably the two I already mentioned, right? One is going to be Walmart because you're going to go back. You're looking to, just given the backdrop, right? Consumers are looking to stretch these disposable spending dollars. We know that consumer debt has been rising. We know borrowing costs are going to be higher. They have been able to manage these because of the wage gains that we've been getting, but they are starting to really stretch those dollars. So to me, the two companies that really stand out, first will be Costco, very differentiated business model, that membership stream, simply wonderful in my opinion. And then the other, of course, is going to be Walmart.
Yeah, I mean, that makes sense when we're talking about staples. We also heard from many of those Staples CEOs that are continuing to do well here.